Good day. Today we are going to do the balance sheet. So we are going to do the balance sheet and also the notes. You can see these are the notes that you are supposed to do. So most of the time you won't be told to do all these notes. All these notes. So what you will need to do is you will need to do all these notes under the I mean you will need to do all these notes in brackets. Okay, you will need to do all these notes in brackets because most of the time you will not be told to do these notes. Okay, now let's come and do them. So they said the year ends on 28 February 2021. um then they are saying prepare the following notes to the balance sheet. So we are doing these three notes, and then we are also doing the balance sheet. Okay, so let's do them. So let's start, or wait, let's just go to the adjustments. Adjustment letter A, the owner of Venus stores contributed 108,000 cash as an additional capital on 31 August 2020. This has been properly recorded. So the owner contributed the capital, right? So here is the capital. The capital is 1,000,000 and 30,000, right? So they're saying that this has been recorded. So this means that this is the capital at the end of the year, right? So we need to find out that how much is the capital at the beginning of the year before the increment, because it was added this much. So we need to subtract this 180,000 so that you can see that how much was the capital at the beginning of the year before the increment. So 1,030,000 minus 180,000, that is 850,000. So this means that the capital at the beginning of the year, it was worth this much. So let's go to the owner's equity notes. Owner's equity notes. Here it is. The capital at the beginning of the year, it was 850,000. We said 1,030,000 minus 180,000. So then the additional capital is 180,000 because the capital that was added during the year, it is 180,000. And then they said took the stock for personal use. So the owner took the stock for personal use at the cost price. Now, what you need to know is this. When the owner is taking the trading stock for personal use, the owner takes the trading stock for personal use um, at the cost price. Okay? The owner takes the trading stock for personal use at the cost price. So value here, it's given at the cost price. So these are the drawings. The drawings, they are how much in a trial balance? They are 125,000. So the drawings, they must be recorded under the owner's equity notes. So it's 125,000. So you see that they said that this has not yet recorded. It is not yet recorded. So we have 11,000 plus 11,000, right? So 125,000 plus 11,000, that is 136,000. Now the question is, when the owner is taking the trading stock for personal use, what is supposed to happen to the trading stock? The trading stock is supposed to decrease. So you can see that the trading stock here in the trial balance, um, it is 310,000, right? The trading stock it is 310,000. And you know that the trading stock it falls under the inventories. So you come here and decrease your trading stock with 11,000 because the owner took the trading stock, right? Um, okay. So the drawings we must subtract them. So therefore we must put them in bracket to show that we are subtracting them. Okay, letter D. The following adjustment must be taken into account for the balance sheet. The first one, amount owed for electricity. So if they're saying amount owed for electricity here, this is an accrued expense. So accrued expense, we record it under the trade and other payables. The trade and other payables, accrued expense. So let's put it here in brackets, just in case we have another accrued expense, 3.9. Okay, the next one, commission income received in advance. So if we have an income that is received in advance, that is a deferred income. It's an income received in advance, which is a liability. So it must also be recorded under the trade and other payables. Deferred income. How much is it? It is 15,000. And then the next point, an advertisement costing 14,000 will appear in the newspaper in March 2021. Payment was made and recorded in February 2021. This advertisement is for March 2021, and our year ends on 28 February 2021. So this means that we paid for the advertisement of the next financial year. So if we pay for the advertisement of the next financial year, this means that that is the prepaid expense. So we know that the prepaid expense is an asset to the business and it falls under the trade and other receivables. So we must come here and write it. So it is 14,000. Okay, and then picking material on hand at the end at the year end, pay physical stock count. So when they are saying this, um, the picking material on hand, that is actually the consumable stores on hand. That is actually the consumable stores on hand. So it's how much? 7,300. Okay, and then they are saying rent owed by tenant. So the business here is being owed the rent. So meaning that that is an accrued income, which is an expense to the business. I mean, which is the asset to the business. 8,000 rand. All right, let's continue. Um, let us see. Fixed asset includes an amount of 182,000 paid to Ace Builders for building a storeroom. So they built a storeroom. So this storeroom costed them 150,000. So this is the cost price of this storeroom, right? So remember the storeroom that is an asset to the business. So this storeroom costed 150,000 and repairs to the roof of the shop. So the repairs, this one is not an asset, it's an expense. So, but then this repairs, it is included in the fixed asset. So therefore, we must go and remove it because they are saying it is included. They are saying the error must be corrected. So let's go um, to the fixed asset and decrease them because this 32,000, it does not belong here under the fixed asset. So 1,191,200 minus 32,000, that is 1,159,200, right? Um, and then letter D, 25,000 of the fixed deposit. At the top, a bank matures on 31 May 2021. Now, our year ends on 28 February 2021, right? And then in a period that is less than 12 months, we are going to get back our fixed deposit. So this means that this is no longer um, this is no longer this is no longer a long-term investment. This is no longer a long-term investment. So it is now a short-term investment. So we must go to the fixed deposit. The fixed deposit is how much? 120,000. We go to the fixed deposit, 120,000, and then we must decrease it by the 25,000 because now the 25,000 it is short-term investment. Yes, in a fixed deposit we still have the 120,000, but then some of it is now a short-term investment. So that is 95,000, right? So now where do we record the short-term investment, which is the fixed deposit? We must record it under the cash and cash equivalent. Or we record it under the cash and cash equivalent as a fixed deposit. So this one is a fixed deposit maturing within 12 months, 25,000, right? And then they're saying a direct payment of 15,000 was made from the bank account to settle the monthly repayment of the loan from the Star Bank on 28 February. So the business made the payment on 28 February, but then no entry has been made. All right? No entry has been made. Now, when the business is making a payment, it means that the bank is supposed to decrease, right? But then in this case, we don't have the bank. We have the bank overdraft. So the bank overdraft is a liability, right? It's a liability that must be recorded under the current liabilities, bank overdraft. So it means that actually here we are owing the bank money, 64,700. 64,700. So, and then we paid the bank with an amount of 15,000, right? We paid Star Bank. We paid the loan for 15,000. So actually, the bank was supposed to decrease. The bank was supposed to decrease because the business was making a payment. But then because this is a bank overdraft, it's a vice versa. The bank overdraft is going to increase. because now it means that the money that you are owing the bank for the bank overdraft, it is going to increase because it means that we paid this loan again with the bank of the money of the bank. Okay. 64,700 plus 15,000, that is 79,700, right? And then the last part, before the last part, we are told that the business made a payment and no entries were made. So we know that when they're making a payment, the loan is supposed to decrease. The loan is how much? 350,000. So the business made a payment of 15,000. The loan was supposed to decrease, but then this was not recorded. So 350,000 minus 15,000, it is 335,000, right? And then almost done. The net profit for the year amount to 235,000 after all the adjustment taken into consideration. So the net profit, we must record it under the owner's equity note, which is here. Net profit. The net profit is how much? 235,000. 850,000 plus 180,000 plus 235,000 minus 136,000 is equal to 1,129,000. So that is the owner's equity. That must go to your balance sheet. 1 million. This is the owner's equity. So it's 1,129,000. 1,129,000. So, and then so we are done with the adjustments. So let's finish up these notes. So the first one, inventories. So 210,000 minus 11,000, that is 299,000, and then plus 7.3. The inventories, they're actually how much? 306,300. So let's go and record the inventories under the balance sheet. So note this. If we were not told to do the inventories note, it means that those calculations, we were going to come and show them here in brackets. Okay. The next one, it is the trade in other receivables. So prepaid expense, it is the 14,000, and then accrued income 8,000. So you can see that here in the trial balance, we don't have the accrued expense and we don't have the accrued income and the prepaid expense. So let's add them together. For 8,700 plus 14,000 plus 8,000, that is going to be 70,700. That is a trade in other receivables going to your current asset. Trade in other receivables. 70,700, right? And then after that, we are going to have the cash and cash equivalent. So you can see there's in the cash and cash equivalent, we only have these two because we don't have the bank, and then we also have that we also don't have the cash float. So we just have to add these two. This is going to be 26,200. Cash and cash equivalent 26,200, right? So let's add this up. Um, here, let's find the non-current asset. It is 1,159,200 plus 95,000. That is going to be 1,254,200, right? And then now the current asset 306,300 plus 70,700 plus 26,200. That is going to be 403,200. Then to find the total asset, you must add the non-current asset plus the current asset. So adding those two, we're going to say plus 1,254,200. It is going to be 1,657,400. Right? Now we go to the here. So in here, we still have to do the trade and other payables. Trade and other payables. Let's go and check in the trial balance. You can see that you have SARS payee and the creditors for salaries. They were not recorded. Payee. Payee, it's how much? 3.2. And then creditors for salaries, 16,000. Remember, the creditors for salaries, this is a net salary. This is a net salary. And then here we have 3.9. This is going to be 15,000. So let's add this together. 15,600 plus 3.9 plus 15,000 plus 3.2 plus 16,000. This is going to be 93,700. 93,700. That is a trade and other payables. Trade and other payables. 93,700. So just come and check if there's something remaining, because in here so there's nothing else here. There's nothing else here. Okay, so to find current liabilities, we just have to add these two together. 93,700 plus 79,700. It is going to be 173,400. Right? Now to find the total equity and liabilities, we have to add the owner's equity plus the non-current liabilities plus the current liabilities, right? So that is going to be 129,000 plus 35,000 plus 79,700. That is going to be 1,543,700. So you can see that our balance sheet is not balancing. So now what could be the problem? So this means that we made some mistake. So this one is 1,657,000. So minus 1,657,000 400. That is going to be 113,000. So let's check if you made any mistake here. Let's check if you made any mistake here. So far, there are no mistake here. There are no mistake here. So we may have made some mistake when doing the calculations, suppose, because there is no mistake here. We have made some mistake when doing the calculations. Let me check. It could be that mistake. Where is that mistake? Because right now I don't see any mistake. There's a mistake here. There's a mistake here. Surely we made some mistake. Some mistake. Surely we made a mistake. Surely we made a mistake because it's not balancing. It's not balancing. In our balance sheet here is supposed to balance. So now what is the problem? What is the problem? So because the owner's equity, it's alright. Current liabilities. Now what is the problem with the current liabilities? Okay. Oh, we made a mistake here. Was it supposed to be 64,700 plus 15,000? What? There is no mistake here. There is no mistake. So I think the mistake must be in the paper because actually there is no mistake here. Thank you so much.